Hello guys, and welcome to what is now the third part, I think, in the series of videos that we are doing on short-term trading patterns. My name is Peter Riedlinghuis from Herenya Capital Advisors. Herenya Capital is a licensed and registered financial services provider in South Africa, FSP number 47080. It's just a little disclaimer that I must put in. You can follow me on Twitter at TraderPietri. You can join us in the Discord. The link is in the description below. The Discord is basically a resource for you guys to chat with us, share ideas, form community. Let's learn from each other. In any case, we are going to jump straight into it. We are continuing with short-term reversal patterns. We're going to finish up some thoughts and ideas about the previous video that we did, which is looking at gaps. And we're going to be looking at some of the variations on gaps that you get. So obviously we did cover gaps quite extensively in the last video, so please go and have a look at it. This is just sort of finishing up a couple of the final thoughts in that area. And this time, thankfully, my mouse is working so I can show examples. So one of the variations that you get is a spike, or also known as a wide range or large range bar. It's very similar to gaps, although these usually are essentially gaps that happen intraday. So there's no real chance for the gap to form when you're looking at a daily bar. So instead of an empty space, there's now a solid line where there would on a daily bar be potentially a gap. This could just be, as explained, that the gap took place intraday on maybe a 5-minute or a 1-minute interval, and then on a longer time frame that does not necessarily reflect as a gap. But as is the same with gaps, it is usually a result of some economic or news event. Gaps have different reasons why they form as well, outside of those, obviously. But intraday spikes or gaps are usually as a result of something to that effect. And as with gaps, it is potentially the beginning, midpoint, or end of a trend. Basically, they share all the same properties as gaps, and they must be analyzed much the same way. So as we can see in our example over here, we see quite a big spike in the price of gasoline futures, which followed by quite a sustained move in that same direction over the next couple of days. And this was, in fact, an intraday gap that, if you look at a daily bar, it just reflects as a spike. And if you look at the formation here, there's a significant resistance level here, and we broke out. So this is a breakaway gap that took place on an intraday basis and reflects as a spike on the daily. Moving on to the dead cat bounce, and yes, this is actually a technical term and not just some crude saying that traders and people use. There's some debate. I'll give you some history. There's some debate around where it comes from. Around when I was born in 1985. I'm not 100% sure of which month it was, but in 1985, the Financial Times ran an article by a reporter called Chris Sherwell, and he used the term dead cat bounced in a piece that he wrote about the Singapore Stock Exchange at the time. Then there was a guy called Raymond DeVoe Jr., who was a research analyst, and in 1986 he was driving around with a bumper sticker that said, "Beware the dead cat bounce." So there's a bit of debate as to who started it, but I mean, it's as old as I am, so hey, maybe I'm the dead cat, who knows, right? In any case, so the dead cat bounce is most profitable and more easily recognized after a very large downward breakaway gap or a breakaway spike, right? And obviously a downward breakaway. It can't be, you don't get a dead cat bounce in an up move, it's a dead cat bounce in a down move. And it's most profitable when you recognize it, for what it is. So what you have to say, or what you have to do is you have to identify what's called an event decline. So this is when there's that really large, sudden drop in a share price or in a commodity price or asset price, whatever it is, and it's like this really violent move. That is called an event decline, usually because of some sort of an economic or news event that caused it, right? It usually lasts for around 7 days, and usually historically we've seen that it is the beginning of a new longer term downtrend in the price. So the dead cat bounce characteristics include stuff, it's basically a short term rally. It lasts sort of between a few days and 2 weeks, depending on how violent and big this event decline was. The event decline, for it to be a dead cat bounce, the event decline must be in excess of 20% down, right? Even if it's just 1 day or 1 week, it must be down at least 20% or more. And then that dead cat bounce can be anywhere from 5% back up to 10%, to can even potentially even retrace the entire move, or not the entire move, but at least back down to the extreme of the consolidation, or the consolidation sort of low, the breakout low. Bukowski in 2010, in his book that he published then, found that 67% of dead cat bounces lead to continued downtrends, but they have also a very high rate of pullbacks. So and in general, from the lows of the initial event decline, after the dead cat bounce, it usually leads to another 18% decline, and the second bounce, or the second decline after the dead cat bounce, is obviously a bit less intense. So a couple of things: not all event declines include a dead cat bounce. Sometimes the bottom falls out and there's no dead cat bounce, right? Event decline must first be recognized for what it is. So you first have to see, basically understand what is happening, and see that there is an event decline. That is kind of like the main point here with the dead cat bounce. Then you wait for the initial sell-off volume to sort of taper off and decline, and you look for a rally on lower or decreasing volume. So this can go as potentially as high up as the lower edge of the breakaway gap, as I was mumbling and trying to say earlier, or if it's not a daily gap, or but rather like a breakaway spike or an intraday gap or something like that, the rally could go all the way up to the edge of the intraday gap, or intraday breakaway gap, or as such. Or if there's no gap on an intraday basis either, then it can go all the way up to essentially where this sudden event decline started, or the spike started. So the way to trade it would be to wait for a short-term pattern, or a confirmed point of resistance on a daily time frame, and then to trade in accordance with whatever that pattern is, whatever the entry criteria is or risk criteria is. You could also stop loss sort of at the dead cat bounce extreme, right? So the highest point within the dead cat bounce could be just above that, could be your stop loss on the short. So and for those who are bottom fishers, I know that often people go, well, this thing's down 30% in 3 days, it's got to be a buy. Statistically, the odds are that after a significant event decline, for the next 6 months, most, if not all, bottoming patterns fail continuously, one after the next. So in general, after an event decline, dead cat bounce occurs, and there's a continuation of 6 months of downtrend. That is basically how they work. So the dead cat bounce is just the opportunity for you to get on the trend. So to give you an example, I look at Aspen Pharmaceuticals. This is a company that has had a series of event declines, or bad news events hit it in the last little while. As we can see, in September of 2018, there was an event decline that basically lasted 2 days. Well, a bit longer. We had two sort of massive down days from around 260 Rand a share all the way down to, about 170 Rand a share, followed by a sort of sustained move down. And all the way through here, we can see actual little bounces there. There's probably one all the way to the top here. This little green candle here probably count as one. And then I marked this one off because, believe it or not, from the lows here to there, that's a 11.08% rally. That's quite significant, followed by another sustained move down. Then once again a very large bounce in percentage terms, and the move just sort of continues down all the way. And every now and then we get these pullbacks, but things didn't look up for the stock, and we had another event decline at the beginning of sort of the early stages of 2019. 2 days later was the peak of the dead cat bounce, and it sort of drifted down. And now we saw this was the 24th, the last candle here is the 24th of April. On the 23rd, looking at that little bar formation, that is a confirmed, well, to this point, at least at the time of recording this, that looks like a DeMarco Williams point of resistance. So this could potentially be a dead cat bounce as well. Time will tell. Okay, moving on to the last part of the gap variations is the island reversal. So an island reversal can occur as both a topping or a bottoming pattern, and usually at the end of a relatively long trend. It can occur in some congestion or consolidation areas, but it's not very common that it does, right? So in order for it to be an island reversal, it must consist of two gaps that are roughly the same, are roughly at the same price and are roughly the same size, right? So the first is in the direction of the trend, and that turns out to be an exhaustion gap, so that reverses. And then the second is in the reverse direction of the trend and is a breakaway gap, and this starts a new trend, in the other direction. The larger the gaps, obviously, the more significant the reversal is. And between the two gaps, there could be a period of low volatility trading that can last, anything from a few days to a couple of weeks, whatever the case is. Usually, when you have an island top, the volume on the second gap, the downward gap, is much bigger than the volume on the upward gap. And when it is an island bottom, that is not necessarily a requirement for volume to be bigger on the second gap, right? The extreme price in the island, so the highest price in the island in the case of an uptrend, must be higher than the previous high. And this means that from a Dow theory perspective, where you have a significant high, followed by a low, followed by a higher high, followed by a higher low, that sort of Dow theory uptrend, the high within the island of the island reversal must be higher than the previous high from previous significant high from a Dow theory perspective if it is a topping pattern, and obviously the converse if it is a bottoming pattern. Pullbacks and throwbacks are very common. They happen around 65 to 70% of the time, but failure rates are relatively low at 13 to 17% of the time. So they work very well, although they're very likely to try and squeeze you out, even if you have read the situation right, and they're unfortunately just not very common. But we know that they work most of the time. So I know yesterday in the previous video, I made quite a point of saying that gaps usually do not occur in market indices because they are not necessarily tradable instruments. And then the best example that I could find in the time that I had to look for an island reversal, lo and behold, is on the NASDAQ index. There are exceptions, I suppose. In any case, as we can see here, this is quite a nice example, if you could call it that. We have a Dow theory higher trend that basically comes to an end. It makes new lows, makes lower highs, and we can see two gaps, one exhaustion gap and one breakaway gap at relatively the same price, and that is sort of the best textbook example that I could find of that at the moment. So let's move on then to the next portion of the video, which is 1 and 2 bar reversals. So we're going to start with a 1 bar reversal. So when we're looking at the current bar, when the current bar high is higher than the previous bar high, and the current bar close is lower than the previous bar close, it is called a 1 bar reversal. So all right, you're going to have to bear with me for the next couple of minutes because these 1 and 2 bar reversals, some of them are difficult to find examples for. So I've literally had to take stuff out of textbooks, and I'll even link to the textbook in the description below that I've used for this. But there's a lot of if the high is this, if the low is that. So you might have to just grin and bear it for a little bit. Obviously, there are notes on screen for you to look at, but and I've tried to find chart examples as far as I can, but this stuff can sometimes be a little confusing. So, fair warning. Here we go. So, when the current bar high is higher than the previous bar high, and the current bar close is lower than the previous bar close, it's called a 1 bar reversal. It also has other names: reversal bar, climax, top or bottom reversal bar, key reversal bar. There's tons of different names for it. It's a 1 bar reversal, right? So sometimes this is preceded by a gap or an opening gap, but the bar extreme is not necessarily as intense as like a spike or anything like that. So it's not a spike because spikes are not necessarily reversals, and this is a reversal signal. And obviously, if you have a spike, a combination between a spike and a 1 bar reversal increases the significance, but that's not necessarily very helpful either, because we will see, and I will show you in the next slide, that this is a very common sort of pattern to see, and it's therefore completely meaningless unless it forms part of a cluster of evidence. So remember, in the very first part of the series, we spoke about what a cluster of evidence is. So unless you see a 1 bar reversal as a part of a cluster of evidence, and a relatively big cluster of evidence, it is pretty much useless. Also, they need to be, generally at the top or bottom of relatively lengthy trends for them to have any sort of real meaning. You could also say that, and this is where you can experiment with the stuff, you could add some slightly stronger or more stringent requirements, and you could say that the close may have to exceed the previous bar's low as, 2 bars lows rather than just the previous bar, or it might have to come after a long rally or a long route, or whatever the case is, because as you can see on this chart here, and I don't even think I got all of them. These are all the ones that basically fit the description of a 1 bar reversal. And as you can see, there are just absolutely tons of them, especially in these areas where the market gets a little congested, it goes a bit sideways, and it's literally rapid fire, one signal after the next, and they literally mean nothing. So it's can be helpful. Sometimes you can see they have, on the left-hand side of the chart here, you can see that they do actually, at some occasions, manage to call, turning points relatively well, but those are in trending conditions. When you have this sideways sort of consolidatory type of movement, they tend to be, relatively meaningless. So moving on to a 2 bar reversal pattern then, which occurs at the end of a trend as well, but this time stretches the reversal pattern over 2 bars instead of just one. So Bukowski called this a pipe formation. In the bottoming pattern, so I'll start there, the first bar closes in the lower half of the second bar, right? And the first bar closes in the lower half of itself, right? So the first bar closes in the lower half of the bar, and the second bar closes near the high of the second bar. So, and usually high volume trades during both bars here. If you get 2 side-by-side spikes, this is obviously the most extreme, also the most reliable version of the formation, but it's like really not very common at all. Usually you have 2 bars that are just of similar size and come after a relatively long trend, right? Obviously, in the case of of a topping pattern, then this bottoming pattern is the opposite way around. So in any case, on either end of the 2 bar reversal, the lows, if we're still working with the bottoming pattern, so we have the first bar closing in the lower half and the second bar closing near the high, and they're equal size or similar size, and they have relatively high volume that have traded through them. And then on either end of them, you have higher lows, right? So think of a DeMarco-Williams method point of support, except now instead of having just 1 bar in the middle, you now have 2 bars in the middle, one which closes near the low, one which closes near the high, right? In that order as well. And on either end of that, you've got higher lows, okay? That is where you're starting to look at what we are identifying then as a 2 bar reversal. It works also, there's a couple of very, very, very faint distinctions or very, very subtle things that you can also look for. So the second bar being slightly longer than the first bar, or the first bar having slightly higher volume than the second bar. These things do make them a bit more, I wouldn't want to say significant is, I think, the word I'm looking for. They often also occur at the end of retracements in long-term trends. And then obviously a directional trade is taken as once the breakup from the pattern is confirmed. They are not very common at all. They have like really, really low failure rates in the region of 5%. But I think over a period of 10 years that this stuff was tested, they average like 2 signals a year or something like that. It's very, very rare that you see them, but they also very, very rarely fail. In retrospect, they're obviously very easy to spot, but they're just very rare to come across. So once the pattern is formed, the price is reversed. Very commonly, you see a retest or a throwback or a pullback. So it does try to squeeze you out, but as long as the bar extremes are not breached, the bar extremes of the two bars at the which make up the two bar formation, as long as those bar extremes are not breached, then you should be okay in terms of not having to stop out. And then so also Bukowski and Kamish, who are both analysts who studied this many years ago, both insist that this formation works better on a weekly bar using weekly data. So I think that I spent a lot of time trying to find these reversal patterns on daily data, and perhaps I should have looked at weekly data because it is a lot more reliable on those. And then a horn pattern is a variation of a 2-bar reversal pattern. It's basically exactly the same thing, just now there's a tiny little bar in between the two that separate them. So to give you an example, on the left we have a 2-bar reversal pattern. As you can see, on either end of the 2 bars there is a higher low, and in the 2 bars in the middle here, the one on the left closes at the low, and the one on the right closes near the high. Right? And on the horn pattern, which is the example on the right hand side, it's pretty much the same thing, except now there is a small little candle that separate the two, and now you've got that formation of horns, right? So in retrospect, these would be really easy to spot on charts, but because they're pretty rare, they're actually really hard to spot because you have to go through hundreds of charts to try and find one. So in any case, moving on to the next one, and we're probably going to move, we're going to spend some time on the inside bar, and then after that, the next couple after that aren't as important, so I'll move through them a little bit faster. So starting with a 2-bar breakout, it's a very simple pattern. Some testing was done for it in 2003 in a magazine called the Active Trader magazine. They had like a testing column that they did some stuff, and they found that it was relatively successful, particularly with commodities. The rules that they used were very simple. They said that if today's low is higher than yesterday's low, and if today's high is lower than yesterday's high, and if today's close is less than today's open, then we want to buy the next day when yesterday's high is breached with a stop at today's low. So it sounds a bit confusing. Basically, it's an inside, well, they're using an inside bar strategy there, right? So an inside bar is a bar where the range of that bar, the high and low, is inside the range of the previous bar. So the previous bar is completely engulfs the next one. As a candlestick, this would be called a harami, I think. So an inside bar, the range of today's bar is inside the range of the previous day's bar, right? So this reflects a decline in momentum and potentially short-term congestion. Like the market's kind of like waiting around for something to happen, right? So during larger congestion patterns, it's interesting because inside bars are generally meaningless inside larger congestion patterns, triangles, rectangles, yes, triangles, rectangles, all that type of stuff. Analysts sometimes, when determining pivots, even delete them completely because they don't really add any value. But within a trend, they can generate relatively profitable short-term trading signals, relatively reliably as well. So we have to just keep in mind, like with gap patterns, for example, you have to keep in context that the configuration of the pattern is more important than the actual the context of the pattern is more important than the configuration of the pattern. So it might be the perfect pattern, but if it's in the wrong place, it's not going to help us, right? So context is more important than configuration. So in 1989, Tony Grable, I hope I say his name correctly, found that even without a cluster of evidence between the years of 1982 and 1986, inside bars in the S&P 500 futures produced a better than average winning percentage. And better than average sounds fantastic, but the strategy that he used was really simple. Okay, so you would buy the next open if the next open is above the inside bar close. Right, so first obviously you need an inside bar. So looking at the two examples we have here, the one example on the left hand side, you see the trading range of the previous day, right? And the candle then is completely inside that. So if the candle opens, if the following day after the inside day, the candle, sorry, it's not a candle, it's a bar. If the market opens above the closing price of the inside day, then you go long. If the market opens below the closing price of the inside day, then you go short. On the long, this had a like a 68%, long or short, 68% win rate, which is fantastic. To improve this, Tony Grable basically added another rule that said that if you want to go long, what you need to do is you need to have the inside day's closing price be higher than the previous day's closing price, and then a higher open after the inside day should be bought. And that led to a win rate of 74%, obviously vice versa on the short, right? He took it even further and said that he wanted to look for a 4-day pattern, right? And on the 4-day pattern, this is now, and he's really sort of trying to drive a point home here. So on the 4-day pattern, basically, what he wanted to do was, all right, so I'll explain it to you. So on day 2, on the example here, on day 2, the second bar, it makes a higher low than the first day, right? So if day 2 makes a higher low than day 1, and day 3 is an inside bar, right? And day 4 opened lower than the mid range of the inside bar, or lower than the close of the inside bar, then a sell signal is generated. So you've got higher lows coming into the inside bar. So you've got an uptrend coming into the inside bar, but in the inside bar, then the day after the inside bar, the market opens lower than the inside bar's close. You generate a sell signal. That had an 80% win rate. Okay? But keep in mind that these signals are like really rare. Okay? They don't come very often. So 80% win rate is fantastic, but you don't get many of these signals a year. On the opposite end, if you had lower lows coming into the inside bar, so day 2 had lower lows than day 1, which is now the opposite of this picture that we're looking at, and you had a higher close after the inside bar, you then had a 90% win rate if you use that as a buy signal. So that's quite interesting, because the point that he was illustrating here is that the direction that the market opens after the inside day, whether it's above or below the closing price of the inside day, is very highly correlated to the subsequent move that the market has, at least the next day. Because with his strategy, what he was doing is he was closing the trades on the same day, so that was purely day trades. But again, he stressed, like other analysts as well, that this works on weekly bars, because on weekly bars, these inside days, you have two bars making up the formation, the initial day and then the inside day. That would be 2 weeks worth of data. So that is a triangle on a daily chart if you're using weekly bars. So this is a nice thing to look for maybe on weekly bar chart. Then you can buy the stuff if it opens on Monday above Friday's close, and Friday was an inside week. You could buy it on Monday and you sell it on Friday, right? And that if you have this particular setup, which might be difficult to find, but you've got a 80 or 90% chance of success, which is great. So in any case, okay, so we're going to quickly just kind of move through the rest of the stuff because this video is pushing 30 minutes already. And I don't want to take too much longer. So there are a couple of things that are not as important, so it is okay for me to breeze through them. So you have there is something called a hook reversal day, which occurs after a series of upward thrust bars, which are called run bars. And when they occur right after each other, and then suddenly out of nowhere a narrow range bar occurs. Now, narrow range bar is something that we will speak about later. We will be looking at narrow range bars and wide range bars in the next video. But in any case, narrow range bar occurs, and this is where the narrow range bars opens above the previous high and closes below the previous close. A variation of this is that you have a upward thrust or a run bars followed by an inside bar that opens at its high and closes at its low, right? So that's kind of signals that momentum is starting to dry up, or the momentum that has been built up to now has begun to slow down. Right, so a downward break then would signal a short trade in this scenario. So now, what happens is with a hook trade, right? Because those are what I've just described now is a hook reversal day. So that's a legitimate sort of reversal pattern. So what happens with the hook is that the people get fooled that they think that this is the pattern that they're seeing, but it's actually not. So what happens is the bar opens above the previous high and reverses and closes and is a down bar. It looks like a reversal day, but it's not exactly the way that it is supposed to be as previously described, because the range must be a narrower range than the previous bar, but in this case it is potentially not, and that then fools the traders to think that the reversal top has occurred when the real signal here is actually to buy a break above, not the hook reversal, but the previous day's closing price. So when the market gets up above that closing price, you go long again. Then we have something called a naked bar upward reversal, which is a variation of the hook. Basically, it's a bar that closes above the previous day's low. And is a down bar. So a bar that closes above the previous day's low and is a down bar. If an inside bar follows a naked bar with an open above the naked bar close, it is a signal that the trend might be reversing. An upward break from the inside bar would suggest that the bears are on the wrong side. Okay, because obviously we've seen that the directional breaks from inside bars are relatively strong. So up to that point, it looks like a fairly bearish setup, and then there's an upward break from the inside bar, and all the bears get squeezed out. Then there's something called Hikkake. I think I'm saying that correctly. It is Japanese for trap or trick or ensnare. It is an inside bar signal that fails, and then because it's failed, becomes a completely new signal in itself. So you can see here in the example that we have, there's an inside bar. It opens and sort of rallies out, and it gives you the conventional buy signal that we would take for it by breaching the inside bar's sort of upper extreme, right? That could be a fairly safe buy signal for it. The following day it fails, and then the following day you see it take out the lower extreme of the inside bar, and that is then called the Hikkake, and you could then sell it there. And what is very important to remember is, or to keep in mind, is that this must happen within 3 bars. Alternatively, it is not a Hikkake or sell, and the formation is null and void. And last sort of thing that we're going to look at quickly is an outside bar. So an outside bar is when the high of the current bar is higher than the high of the previous bar, and the low of the current bar is lower than the low of the previous bar. So this is the opposite to an inside day. This is now an outside day, or an outside bar, where you have the range of the outside bar completely covers or engulfs the entire range of the previous bar. So it's thought to sort of be the start of an increased, of increased volatility. Depending on where it closes, it could also potentially be the beginning of a new trend. If it closes up, it could potentially be very bullish. If it closes down, it could be potentially very bearish. but we've seen sort of that Bukowski once again did a little bit of testing on the topic, and that whichever side of the candle extreme it closes near is generally suggestive of the continued direction of the price action or the trade action after that candle has, or that bar has closed. So if the outside bar closes sort of in the upper 25% of the bar, then there's a 66% chance that the following day is going to be an up day, and if the outside bar closes in the lower 25% of the range or of the bar, then there's about 62% chance that the following day will be a lower day or a down day. And that is all that we have time for. That is the third installment in our short-term trading series. I hope that you will join us for the next one. We are going to be looking at a couple of other things. Volatility patterns, something called a knockout pattern. There is the narrow range bar pattern. There's a wide range bar pattern. And then after that, we're going to do a video on candlestick patterns and all that kind of stuff as well, looking at a couple of 2 and 3 candlestick formations. But for now, that is it. I will see you again in the next one, and join us in the Discord. It'll be great seeing you there.